Hello folks, Steve Lentz here with Discover Options. Welcome to this presentation of market reports. This is for Friday ending March 17th, getting ready for Monday, March 20th. Folks, we have two market reports for you. First, for those of you that trade butters and condors in options, particularly in the SPX, this is the S&P 500 Condor Butterfly timing report. You know, so often when you hear about how to trade butterflies and condors in the SPX, it's more of a seasonal approach, thinking that you can just put on those positions at the same time every month or routinely, maybe wait for a down day in the market or something like that. And instead, what we're doing is really taking the best, we're seeking to find out the best conditions, market conditions, and determining whether now is a good time to put on a butterfly or condor, using some analysis work, some pretty hefty data analysis that I think you'll find very interesting. Next, we also have the S&P 500 directional likelihood report. For those of you that like to trade options directionally and also non-directionally in the S&P, this is more of a statistical based report that I think you'll find very interesting. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So before we get to the reports, I want to go over with you the market condition as we understand it right now. Now, I'm showing you here the chart from the SPX, and notice that we have two consecutive inside days. Two consecutive inside days. That's a very rare occurrence. And if we were to look at that same pattern going back in time, we would only find about 20 of those going back to, well, probably less than that. I'm pretty sure. Yeah, less than that. Going back to Jan of 2000. Jan of 2000 is how far back we're going. So what I did instead is I just looked at the the fact that on Wednesday, we had an up close. Thursday was a down close. Friday was a down close. So an up close followed by two consecutive down closes. That's the price action. And then this is all occurring above the 50-day simple moving average. And it's occurring in the 15-3 stochastic between the values of 25 and 85. And it's above the %D, the 3-day moving average. All that makes up for a market condition. That particular price action in the context of the 50-day average, in the context of the stochastic, that's occurred roughly 32 times since Jan of 2000. That condition, as I just expressed here and listed here, it's not that often. Still, it's kind of rare. Still, it's kind of rare. So, with that said, let's go and take a look at the report. And here it is. Judging from this, it seems that there is a positive edge to selling premium through butterflies and condors. So here's the narrative that I'll explain here. So since January of 2000, there have been over 4,300 daily closes of the SPX. Of those, 64.7% have been favorable bars for selling premium, where the actual 21-bar movement was less than what the SIBO skew adjusted implied movement was. So once again, 64.7% were favorable bars because the actual movement was less than what was implied by the options. Okay, now also during that time, since Jan of 2000, the current condition I just expressed has occurred 32 times. Of those 32 times, 71.8% of the bars were favorable. Okay, not just 64.8, 71.8. It's actually 64.7. Okay, so basically that means we have a 7.1% edge because our current market condition results in a higher percentage of the bars being favorable. So, given that, folks, I just want to point out, for those of you that trade butters and condors, it appears that Friday's close led to what it could turn out to be a favorable environment for selling premium. There's a higher likelihood than normal that the ensuing bars will be, the bar from Friday will end up being a favorable bar, okay? All right, so we're going to talk about the methodology behind this in just a little bit. Let's go to the likelihood report first and go through the results here. What we're doing is basically looking at price distribution bands. All right, so from every close, we have 3 bands above and 3 bands below. And the question is price going to go up and hit the 5, 10, and 15-day band, or the lower 5, 10, or 15-day band set 1 standard deviation away? And on average, over the course of time, for almost 4,300 closes, price is distributed fairly, like this. About 29.6% of the time, price will go up and hit the 5-day 1 standard deviation band. And you can see these percentages here. Now what you're seeing down here are a lot of red and blue numbers. And the red numbers mean that the price does not hit the bands. And these are the upper bands it's failing to reach after our current market condition. Okay, the one I just explained. It seems that under this market condition in the past, price has failed to go up and reach the upper bands near as often as normal, whereas it does go down. And look at these, and we're going to get into the methodology here in a bit more. It does tend to go down and hit the lower bands more often than what the normal distribution is. Okay, so this is a picture of a bearish bias. Doesn't mean the market's necessarily going to actually go down, because we can see that there's been sometimes when it actually has gone up and hit the upper bands. One time in 10, 2 times in 10, something like that. Whereas after our current market condition, it's going down and hitting the lower bands, 30 to 40% of the time. So we're seeing a definite bias here to the downside, and that's how the statistical report is, the market likelihood report is shaping up. Again, we're going to go through this in much greater detail in one moment. We also adjust the bands to be a little more reflective of what the option market is displaying. And still here we see more of the lower bands having blue numbers, where they're getting hit more often than expected here by quite a bit. So that's a bearish picture. There's a higher likelihood than normal that this pattern we have now will end up being resolving itself into a bearish situation. Okay, now so that's it for the veterans amongst us. I'm going to dive in now to the methodology behind both reports. It's the same presentation every week, just to explain it for the folks that are new, that need to hear that and understand it. So that's fine. Before we get to that, I want to point out to you that we have an ebook that you can get by just clicking on the link. And also, if you want to subscribe, we'd appreciate it. Just click on the subscribe button, and that way you'll get alerted whenever we produce some new videos here. Just click the link, and we'll give us your information. We'll get you this ebook out to you as well. It's co-authored by Jim and myself. All right, let's go to the Condor Butterfly Timing Report. All right, and we're going to dive into the methodology, and so you'll understand exactly what's going on behind timing of condors and butterflies using some volatility edge analysis. So here's just a little example. If you're trading butters and condors, you might feel that you could just wait for a market to channel a little bit and then put it on. Well, it doesn't always work that way. In this case, you can kind of see that we have a negative edge once we had crunched this through our algorithms here at the end of December of 15. And when we say that there was a negative edge, what we're saying is that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. See, if we're selling premium through butters and condors, we want the market to be less volatile, all right, than what's implied. Okay, instead, a negative edge means that historically there was a likelihood that this was going to be more volatile. In this case, that turned out to be true. Market took off on the downside, and When what was interesting is the market had been channeling, and a lot of traders would have gone ahead and just gone for it and put on a butter or condor thinking it was going to continue to channel. But we knew from our algorithms that no, that wasn't the case. So you want to pay attention to this stuff. So the question on the table is this current condition, the one I just expressed that you can see here on the chart, is this current condition a good one for selling premium through range trading? Okay, is it a good one or not? And so to answer that, we do this analysis where we first observe how much the market actually moves from a given close. Then we observe what market move is predicted by the option prices. So that's called implied volatility. The actual movement is called actual volatility. And we compare the two in hindsight, after the fact. And we go and label historical bars either favorable or unfavorable. So let me show you an example of this. Let's look at actual volatility first, where you can take a given close, you look forward in time 21 bars, and you ask yourself, how far did the market move? What was the farthest amount that it moved? Well, it clearly moved down farther than it moved up in the ensuing 21 bars. And this turned out to have been 50 points, or roughly 2.4% of a market move. And we can actually graph that down there. So we know what the market did from that point moving forward. But what market move was being implied by the option prices at that time? Turns out, when you take the VIX and convert it to an implied move, it was implying a move of 4.4%, far greater than what actually came about. So in hindsight then, that bar for that day turned out to have been favorable, and we would paint that bar blue for being favorable. Okay, and what we do is we go back in time, years and years, and we paint the bars either blue or red, just like you see here. The red bars turned out to have been unfavorable, where the market moved more than what the options were implying. The blue bars turned out to have been favorable for selling premium, like that, where the implied move was less than what the implied move was more than the actual. All right, so favorable and unfavorable bars. So what do we do with this information? Well, what we're going to do is look at historically what percentage of all the bars in the SPX going back, what percentage of those were favorable. Okay, then we're going to look at our bars to see the percentage of the current condition bars turned out to have been favorable. What percentage of those were favorable? I mean, what if we find out that the with our current market condition, what if we find out that every single time that it's occurred in the past, the market has just really gone bananas and has been very volatile, far more volatile than the implied volatility of the options? Well, if we knew that, we would definitely avoid selling premium through butters and condors, right? Okay, so we're looking for the big difference there. So here's what we find out. Going back in time, almost 4,300 closes, 64.7% of the bars turned out to have been favorable. 35% turned out to have been unfavorable, where it was a rough ride for the condor and butterfly folks. Now, of the bars that match our current condition, what percentage of those were historically favorable for selling premium? Turns out 71.8% were favorable for selling premium. Now that's a lot more than the 64.7, so that reflects a timing edge of plus 7.1%. And that's how we get our edge number there, folks. Okay, is we just walk through this, looking at favorable or unfavorable, and then looking at our current condition to see historically whether it had the same percentage of bars as normal, or much more or less. In this case, quite a bit more. So there you have it for the condor butterfly timing report. Before we move on to the likelihood report, just want to point out to you that we have a great curriculum at Discover Options. If you want to get up to an advanced trading level with options using some sophisticated strategies to yield some outstanding returns, well, check us out on our website. Give us a call at 847-816-6610. We'd be glad to help you. Let's dive into the market likelihood report. Here's the question on the table. Since Jan of 2000, how often has our same condition occurred, and what did the market do in terms of direction and volatility? What did it do when we go back in time and look at this unique condition that we had here today, or from Friday? So here's what we do. We do this rather than assigning a system to that setup, trailing stop and all that fun stuff. Instead, we look at the distribution of price. The distribution of price historically, and then as a baseline, and then we look at the distribution after a specific condition develops, our particular condition. And then an edge exists if the two are much different. So what is historical distribution of price? How do we observe this? Well, how do we measure it? We measure it by looking at how often price touches one standard deviation volatility bands that are placed from each bar's closing price. Okay, so we're going to determine price distribution. 3 sets of bands, 5, 10, and 15 days above the close and below the close. Okay, and then we use a 20-day historical vol number to determine that width, and these are log normally distributed. Here we go. Let me just show you an example of this. So here we have a close. Here's a 10-day volatility band to the upside, 10-day volatility band to the downside, and the question is price going to go up and hit the upper, go down and hit the lower band, or wobble in the middle? Okay, which is it going to do there? In this case, it went up and hit the upper band very quickly. So for that particular close, we record that it hit the upper band. Now on this close over here, we have the upper band, the lower band, and will price go up and hit the upper, go down and hit the lower, or wobble it around and do nothing? Let's go take a look. Boom, there it is. And it tried to hit that lower band, but it failed to, if we draw that across. And so for that particular close, we record that it hit neither band. So we do this for every single close. And here's the historical distribution. We look at it every close. From every close, we record whether price struck the upper or the lower 5, 10, and 15-day bands. And we record that. And so here's what we have, just as a way by, right now through March 17th, over the course of almost 4,300 closes, price struck the upper 5-day band 29.6% of the time, the upper 10-day band 23.4%, the upper 15-day band 23% about, the lower bands, lower 5-day band 29.3%, the lower 10 29%, the lower 15 almost 32%. So these are the historical distributions of price. All right, for all the closes going back. Now, we're going to look at the distribution after our condition developed. So again, I'm just reviewing this, and what you'll see is what we're going to do is look at the distribution as of the close. We'll look at the distribution if price goes above Friday's high, and the distribution if price goes below Friday's low. All right, I think that'll help us then prepare for Monday's open much better. So what we see then is out of those, and this is 33, out of 33 times that our condition occurred in the past, going back to the year 2000, price struck the upper 5, 10, and 15-day bands far less often compared to the normal distribution. Look at that. Only 18%, 18 and 15%. Okay, big differences. Now look at it, also struck the lower bands more often, 45.5, 39, 39. So it struck the lower bands far more often than the upper. Now keep in mind, we only have 33 incidences. We'd feel better if it was much higher, like over 100, certainly. But it is what it is, and I'm just throwing it out there for you to consider, because it is in fact a very rare market setup that we have right now. This just doesn't happen that often. Now, what if price goes down? What if it exceeds Friday's high, the previous day's high? Again, we still have a situation where the market, where of those 11 times when that occurred, okay, it struck the lower bands more often than normal, and it failed to hit the upper bands as much as normal. Okay, makes sense? Now, what if price goes down below the low of Friday? You could see that happen 19 times. That happened 19 times, and of those 19 times, it then went down and hit the lower bands way more often than normal, and it failed to reach the upper bands by quite a bit there. Okay, and then let's see, I think that's it, right? Oh, and the one thing I like to do is to recast the here, let me do this. Boom, boom. I like to recast the bands in terms of the volatility going into the determination of their width. I use a skew adjusted VIX to make it more reflective of the market's estimation of this. And so typically the upper bands will be closer in and the lower bands will be farther away, but still you see still a similar bias where the lower bands are getting struck more often in general, and then the upper bands are getting struck less. Just a few little boxes that flip the other way, but you still see the pattern persisting. So that's it for those market reports here today, folks. I want to thank you for joining us, and I'm Steve Lentz with Discover Options. We're here to help. Give us a call, and we'll get you in the right curriculum. Thanks a lot. Take care. Bye-bye.